Alrighty, I'm Dennis Hudson at OrangeQuant.com with you again. I want to go back here in part 2 of our options video to cover that last frame a little more carefully. We were talking about what is expiration, and expiration defines the life of your options contract. And you have until the expiration date to either sell the contract that is traded in the open market, or exercise the contract as you saw before, or it will expire worthless. Although some brokers, most brokers, you have to check with your broker, but most automatically exercise contracts that have some value, that are, in other words, in the money. So if you have an in the money contract, well, I shouldn't say that have value. There are those that are out of the money that have value too. But your broker, check with your broker to see what their policy is at expiration. All right, I'm mentioning here American style options. And American style options are options that you can exercise or trade at any time. European style options have an expiration date, and you can only exercise them on that date. If you're trading with most brokers in the USA, you're not going to run into European style options. Now, very quickly before we get on into more complex areas, here are the basics again. The option contract is your right. If you've bought calls, pardon me, if you bought calls, it's your right to buy 100 shares. If you bought puts, it's your right to sell 100 shares. And puts means you put it to the market maker. You shove it down their throat and make them take it. In the reverse of that example we saw of you exercising a call contract, you force the broker to buy 100 shares from you in a case of a put contract. So you shove it down their throat or wherever you want to, and they have to buy them at the strike price. And contract expiration is the third Friday of the expiration month. When you are buying contracts, make sure that you know which month you're looking at. There's usually a link or a drop-down box or something. We'll come to this kind of stuff later, but I just want to kind of reiterate beforehand. Make sure what month you're buying, because you can buy this month or next month or 6 months out, something like that. Now to this point, if you can read the direction of a stock, it looks pretty easy to make money at options. But in fact, it's not that easy. And here's why. There are 3 evils. And these evils control the price of your option contract, the tradable price in the open market. Those 3 evils are, as you've already seen, the price of the underlying. If you have calls and the stock is moving up, that helps you. Okay, but if you have puts, it's hurting you. There's something called the time to expiration, okay, the time left for you. There's a Greek term for this called theta, and theta can eat you alive, because as the contract starts to wind down closer and closer to expiration, it tends to lose value. Then there's implied volatility, whereas the time to expiration is a constant. Everybody knows what that is, okay, how much time is left. We don't know what the price of the underlying is going to be tomorrow or next week. And we don't know what the volatility is going to be like next week or next month, okay? Implied volatility is the ratio of the internal volatility of the underlying to the S&P 500's volatility, okay? If the contract you have, if the underlying of that contract has extreme volatility relative to the volatility of the S&P, then the value of your contract will definitely go up if it's moving in your direction, okay? And we'll get into some examples of this kind of thing, but I just want to point out what the three evils are: price of the underlying, volatility, and time to expiration. Volatility is called beta, time to expiration is called theta. You can purchase option contracts at at all kinds of prices, anywhere from 10 cents to $10 a contract, whatever. But what happens, this constant of expiration and how it affects price of the contract, or the price at which you could liquidate the contract, is constant, and it's well known, and it traces a path, something like what you see. This isn't a perfect picture, but let's say you purchase this up here at this value. Across the life of the contract, as it approaches the expiration date, it starts to drop faster and faster and faster until it's worthless. It will expire worthless unless something happens in the price of the underlying or in the implied volatility that we were discussing to raise the price up. Okay? So let's say, hypothetically, that after you bought it, very shortly after, the price, let's say you bought calls, let's say the price of the underlying started to shoot upward. Not only did it start to shoot upward, it did so violently with a lot of volatility, perhaps up and down volatility, and now it traces a path. The price of your contract starts to trace a path like that instead of it losing value. This is entirely possible, and it's why you buy the contract in the first place. On the other hand, let's say you bought calls, and suddenly, shortly after the purchase of the contract, the price of the underlying starts to go down, and let's say the volatility goes very flat. Then the effect would be that the tradable value of your contract starts to go down like that. So as you might imagine, with price going up and down, volatility changing all the time, the value of your option contract can be extremely volatile in and of itself. It can go wildly up and down. Now here's a question you have not asked yourself, I'm almost certain, because I hadn't asked myself, and then one day I ran into it. Is there a way for both puts and calls to lose value at the same time? In other words, you'd figure there's something called the theory of a fair game, where if one side is winning, the other side is losing. And you would expect that if the calls are losing, the puts ought to be winning, right? In other words, a zero-sum game. Well, that's just not the way it works. There is, in fact, a way for puts and calls to lose at the same time. And you got to watch yourself on this. Remember this bit, because there are those snakes out there who control the market, who decide the prices, who want to make this happen. And here, ladies and gentlemen, is how they do it. Let's say this is a stock, and let's say you have calls. As you can see, it's moving in your direction, but it's moving so slowly, it's killing the volatility. And it's moving so slowly that expiration, this big red dot, is getting closer and closer. And so you lose on that, and those who have puts are also losing because it's moving away from